lesson is on volume analysis. So volume analysis is really straightforward, but as always, the majority overcomplicate it. You might think, if you haven't used volume profile before, which is the method that we're going to talk about, you might believe that volume analysis is relating to the candlesticks along the bottom of a chart, such as this. Typically, people see volume as these areas. You have candlesticks on the chart to represent the movement of price over a certain period of time. At the bottom, you have a histogram, which are these bars, representing the amount of volume in each of those candles. While that is a method of volume analysis, or one particular method of volume analysis, it is not the one we're going to talk about, and it's not the one I believe is the most valuable or useful. Instead, what we're going to talk about is volume profile, also known as market profile, somewhat incorrectly, but the terms are interchangeable. I'll explain in more detail what market profile actually is in a little bit. It's essentially just the collection of ways that you can view the data. But the volume profile, as you can see from my excellent artistic skills, is essentially just a bell curve expression on a chart. So back to the chart. We have on the x-axis, we have single bars representing volume within the candle. That's typical, what people traditionally view as volume. What we have in volume profile is actually this. So it's the bell curve representing a normal distribution, but we have it vertically to represent the volume across a given time period. And it will look like this, with the peak, of course, being the point at which there is most volume traded within that given time period. All right. So, as I said, it's simple. I talk a lot about filling the gap. And what this refers to is filling the gaps in the volume profile of a chart. You can visualize this with candles only, or by using volume profile, which we're going to talk about now. So to visualize that with candles only, you could say something like this. Anytime the price moves down or moves up in a manner where there are multiple of the same color candle, so many red candles with no bounce, you can say there's a gap there. Same as here, there's a gap. Okay, so with candlesticks, you can do very rudimentary analysis of gaps. And so when I say filling the gap, it means that price, if I say price is down here and I say it's going to fill this gap, it means I think the price is going to bounce up into the gap here, like it's doing in this example. So that's how I do it with candlesticks. But a more sophisticated and accurate way to do it is by using the volume profile. And so when you see a gap, assume that it's going to be filled in. Why? Because price wants to be normally distributed. Why do you say that? Well, I don't know. Is it a law of maths? Is it because algorithm-driven markets are coded by quants who believe in normal distribution? Or is it the expression of the bell curve meme in the charts? So, the bell curve meme is exactly what I'm talking about. That is what volume profile is. This part here, where it goes up and down. You flip that on its side, vertically, and that is how a volume profile looks. That is intentional. It is maths, and that is probably why it is relevant in markets, because markets are, heavily dominated by mathematical and computer science types who code and trade using algorithmic strategies, and volume tends to follow some of these principles fairly efficiently. So don't be the guy in the middle of the bell curve. We all know that we don't want to be there. Don't be that guy. On the right, you can be the 145 IQ Chad. Or you can just be the retard on the end who understands to not overcomplicate things and just accept that when price makes a sudden move up or a sudden move down and leaves a gap, that at some point it's going to want to come back and test that and fill it in. because, as our chat on the right says, our genius, GigaBrain, volume tends to distribute itself evenly because of Gaussian distribution, which is just another term for normal distribution, which is the bell curve, normal distribution, okay? It's actually very simple. It doesn't matter why, forget about the why. Just know that this does happen in markets. And so if you know that it happens in markets, you can trade based on that, and you can make money. And that's all that matters. So I don't know why. All I know is a price isn't always normally distributed, but that it wants to be. And so it tries to, and that's how we fill gaps. All right, so I'll show you two quick examples on candlestick charts. One, here you see a gap being formed. Price pumps up. It then consolidates for a little bit, but then it drops back down. That is not filling the gap. The gap still remains. If you look, price was consolidating. It pumped up, inefficient, went sideways, came all the way back down, inefficient. So everything in this part here remains as a gap. So what happens? Well, we go down a little further, we consolidate, and then what does price do? It bounces, and it begins to fill in this gap. And if you look right up to the top, right up to here, and obviously from the bottom, from down this area, it filled in every part of this gap. And so when you zoom out and look at it as a whole, this is now a normally distributed period of price action, because volume has been distributed right across the range from high to low. That's just how it goes, guys. That's just how it works. Happens on all time frames, from the 1 minute chart right up to the 1 year chart. So to actionably trade that, you have many ways of doing so. It can help you not just to trade, but also to avoid trades. You can say that as price bounces into this area here, and it holds at this level, so we created a gap up, and then it dropped down. So we had this gap here, which started to get filled. And so no matter what's happening here, whether you're trading or not, you know that the highest probability, once it begins to fill this gap, is that it's going to fill all of it before making its move in a different direction. So at least you'll know not to go short in this area, not to go crazy on a short, because chances are it can go all the way to here. So you could just set some orders up in this area, knowing that when it fills, there's a decent chance it reverses. So you can already begin to see how volume can help you. And this is just with candlesticks. What I'm showing you right now, you could actually make trades based just on candlesticks. But we're going to get more sophisticated with this and show you how volume profile works on a deeper level. Here's a second example. You have a gap forming in the form of a pump, and then price holds for a little bit, then it drops back down, but it doesn't fill in right down to the bottom of the gap. It bounces again, eventually fills right down to here, but with a long wick. So again, this long wick and this big down candle is an inefficiency in and of itself. So if you look at this candle, this big candle, we need to start filling it in, but you have to fill it in an efficient manner. Like I showed you here, if you do a big candle up and you fill it with a big candle down, it's not a completed move. It's not a completed retest or distribution. It's not the way the market wants to be. The market wants to properly test and fill these areas. Again, don't worry about why. It's just a phenomenon that happens over and over again. So we gapped up. We started to fill it nice and efficiently. You can see here, a drop down, but then a bounce. Drop down, but a bounce. Then a big drop. The big drop, then we start to bounce within that and fill some of it in, continue to fill in all the way until we lose that range. Now if you look back from the bottom of this pump all the way to the top, in the red box that I've drawn, it went from being one inefficient move to being a more efficient mean reversion along with a gap fill. And all of that is because of the distribution. So that's how you can look at volume gaps just using candlesticks. But to actually visualize it in the way that we want, we can move on to the volume profile, which is a setting that you can have on your chart. So a standalone volume profile will represent the volume within a specific candle. So we go to the chart here and we take a look at this. So the chart, and I'm doing everything on this on TradingView. There are softwares such as ExoCharts that you can pay for that have sophisticated volume profile and market profile analysis. But I don't want to use those. I want to show you, as always, tools you can use for free. So on TradingView, we have this. Now I've already added the session volume profile. All that is SVP. So when you go into the indicators, just go to session volume profile, SVP or session volume profile. Click on that and it will give you the volume displayed in the format I mentioned in the bell curve vertically for each day. If you look down here, each one of these is one day that is shaded in light blue. To get a better view of this, I recommend removing the candles. Just go to settings, remove the 3 candles sections, and then you can view it more clearly. I'll actually change the color as well, just because it might be a little bit easier to see against the background if it's in a different color. So what can we see now? Well, what we see now is each day is represented as a distribution based upon the volume. So at the highest point, let's take this daily candle for example. Here, at this highest point on the 23rd of November, the most volume was traded at 16,500 if you look on the right hand side on the axis of price. So that was where the most volume was traded for that day. We have a gap here. So down the bottom, we have a gap on this daily candle. And so I'll just draw a box across for it in a second. You'll see why. But we had a gap. We had 2 higher, these are called nodes. So each peak on this volume profile, you can call it a node. So we had high volume nodes along here. Basically the majority of the volume was being transacted in this area. We went on to the next day, so 21st, 22nd, on the 23rd, price pumped, and we spent most of the day up here, and we left a gap. Price then consolidated for a number of days up at this area. Again, fairly efficient. And then it gapped down. So we left a gap here as we moved down. And look at what we did when we moved down. We moved back into the area that was previously left inefficient. So we gapped up on this day, consolidated, gapped back down on this day, consolidated, filled it in. Remember what I said? Keep yourself on the left or the right of the bell curve meme. Volume wants to come back. Price wants to be normally distributed. So it wanted to come back and retest here and fill it in, and it did. But it left a gap here. So what happens the next day? We move up and we fill that back in. Notice how these things happen. The patterns become clear. Price wants to move to areas of previous inefficiency, aka gaps, and refill them. You can then see the following day it gapped up pretty significantly. There was very little volume traded here. If we drag that across, this would be how I would be viewing it as a trader. We have this gap here. We then come up much the same as how price gapped up into here, consolidated, came back down, and then went up. All right, much the same. We did this. We gapped up. We've been consolidating. and we have a gap below which we haven't filled yet. So do we drop down into here for a day before going up, or even before going down? Either way, the likelihood is yes, we do go down into this box. So that's just how the charts work. So the high volume nodes are the areas in which more traders are positioned. So let's think about it this way. We've now been consolidating for a number of days, and you can also visualize this using something called a point of control, which sorry, that's on the chart. Let me put this on. POC, if you go into the settings of the session volume profile, you can add the POC, and that will put a red line across the highest volume part of each session. So it's a little bit of a cheat code for you. So if you're new to using this, instead of having to visually kind of discern where the highest volume was every day, you can see very clearly. There's a nice example here where we had POCs, point of control, the highest volume of each day, in really tight grouping. So we had points of control all along here for a few days. All right. What does that actually mean? And how is it actionable to us as traders? As I put a couple of lines across here, just to help us visualize this area. And I'll put it into green, just so that it stands out. So from the 23rd to the 27th, we had a lot of volume being transacted in this area. Well, high volume nodes, aka the fat parts, aka where the POC is, they indicate more interest. Guys, this is pretty obvious stuff, I'm sure. But the more volume that's transacted in a level indicates more interest. If there's more volume there, that means there was more buying and more selling in that area. What does more interest mean? More interest means that there are more traders who have an opinion at that level. What does that mean? That means that more traders are in a position that has a entry at that level. Think about it. You can only do two things. You can either enter a trade or you can exit a trade. So if all the volume was being consolidated and happening in this area, that means a bunch of people were entering or exiting trades. So let's just focus on the guys that entered the trades. Guys who exited, doesn't matter, they're already out. But the guys who entered the trades and have fresh positions open in this area, doesn't matter if it's long or short. What we do know, we don't know how much is long, how much is short. What we do know is that a lot of people were entering at this level of 16.5. So logic dictates that the further away we move from that high volume area, either up or down, the more traders are under pressure of getting squeezed or stopped out or liquidated. So this does two things. It increases the likelihood, number one, it increases the likelihood of these high volume areas acting as support or resistance, because traders are incentivized to defend the area. Let me give an example. Let's imagine a bunch of traders. Let's imagine the majority of flow in this area where we have a lot of volume. The majority of it was short. Okay? Then price drops down. Great. The shorts are in profit. They're doing well. Then price comes back up to here. This level is now the break-even point for all the guys who went short. So they're more incentivized to defend that level. So that means that when we came up here on the 29th, that was as high as it could go. It couldn't go any higher on the 29th because people were defending it. There was more sell orders there. They were selling because they were desperately trying to defend their position because they had went short all along here, or they sold all along here. So they wanted to sell more here in hopes that the market would drop and they would be in profit. In this particular instance, they were only able to hold it off for one day, and the following day it gapped up violently with a squeeze and pushed all the way up to here. The reason it moved up so significantly is because we had 4 or 5 days of high volume build up at a certain level, which meant that when price moved against them, they were offside and they got squeezed, liquidated, stopped out along the way. So that's how you can use volume. And smart traders among you will be noticing that something similar is happening in this area. So as price moves up and down across the charts, you find these areas of consolidation. And the further up it goes, we know, the closer it is to coming back down, and the further down it goes, the closer it is to coming back up. So a bunch of people were trapped here short. They briefly were in profit, couldn't defend their level, and then they got squeezed up. So now who's in trouble now? Well, the probabilities would say that the longs are in trouble now because you've a lot of volume building up in this particular area here. So at the 17,000 to 17,001 level, we've had about 6 days. 1, 2, 3, 4, 5, 6. 6 days of high volume, the highest volume being at 17 to 17.1, and we're starting to drop. Price just dropped down yesterday, and today it's still down. It's trying to push up as I record this, but it means that the people below this line, below this level, are in trouble. And similarly, of course, if it goes well above it, then they will be in trouble too. So, because of that, because you have these areas where volume bunches or groups, it in turn creates support and resistance. All right? So, much like here, and what I do with these to actually use these for future reference, you draw around them. So, I would take my level like that. And I'll just fill in a little bit of color on it and extend it right. Say, okay, something in this kind of area where these points of control are, there was a lot of volume being transacted at this level. We went down below it, we've broke above it, we haven't retested it, as you can see. So this would be my area I'm looking at to say, all right, I expect price to come to here, but also I probably expect price to hold when it does come there. Because there was pretty significant consolidation there, and when it comes back down, it should probably be able to find support as well. Unless there has been so much distribution going on up here that price is able to break through this level and go lower. But anyway, you should still have this drawn and leave that there until it's tapped, and then do the same up above. We had this initial move up, then we had 1, 2, 3, 4, 5, 6 days where it's from about here. So this was the lowest, looking at the points of control, up to the highest. I'll say up to there. So between 16,936 and 17,1 pretty much is now our resistance level until it's broken through. So you can put that in red. And then as you zoom out and you want to look at your market, you could now say, okay, with the distribution that's going on, what can we see? Well, we can see a bunch of people were going long and short here. Eventually, the short side were offside and got squeezed. And now a bunch of people are going long and short here. And we're starting to drop down. So it looks like the longs are offside. Also look at something like this, where on the 5th of December, we had an unusually high, block of volume up here. If you notice before, on previous days, price could only put relatively low volume in these areas above 17.1, but on one of the days we put a pretty significant amount of volume up there, and then price failed to go higher. It rejected back down. That is very likely to be trapped traders, because when price tries to go somewhere with a lot of volume and goes in the opposite direction, you can assume that people are offside there. There's a bunch of longs that essentially long the top, and it's usually a catalyst for price to go lower. So that's a sign, using just the volume profile, that you can spot a top with. So from everything I'm seeing here, I would say the Bitcoin top is in, and that we're expecting a retrace to fill in some gaps below. Now, so when I say the top is in, it doesn't mean that we have to go significantly lower. It just means that we have to go back down and find an area of support so that we can then go back up again. And so key support and key resistance levels will often produce these massive liquidation spikes when breached, because the volume distribution has been building for many days or weeks. So what does that mean? Well, we're over a week now up in this area. We've built a pretty significant resistance level, because volume has built up. So if it gets breached, meaning if we properly lose this level, it's dropped down and it's trying to reclaim, but if it fails and it drops down again, all of this previous volume is under pressure. All the long side of this is under pressure. And if there is enough of a build up there, that's when you can see one of these big drops, a more significant sell-off. So that's how volume analysis, the volume profile, can help you with that. So you're marking these levels because the green box is where you know that traders will be incentivized to defend. The traders are going to be incentivized to defend because they were willing to buy and sell heavily here just a few days ago. Similarly, up here, the traders will be incentivized to defend this as resistance, because whoever was going short in here, they got their initial breakdown. It's retesting, but you can be sure the price is going to struggle to get back through this level. And what's most likely is they'll find more selling resistance and sell off into this area. Now, when it gets here, what are we looking at then? Back to what I'd said before. Back to your bell curve meme. We're filling the gap. All right? So this gap here, from when it went on this point of control and pushed up, you've got a gap in this area, which I'm going to mark in blue. And fade it down. Because you can see these different, you can see all of these distributions. They group nicely. So the peaks all group nicely, drops down, comes back up into the same area, pushes higher, groups nicely, most of the peaks in the same area. So what's going to happen here? We'll look at this nice big gap below where there was a bunch of peaks and grouping before. So what you could see is another iteration of that. If I have my bars, if this will work for me. No, it's going to pull the candlesticks. I was hoping I could drag some of these across, but I'm sure you can imagine these. Visualize this same grouping of candlesticks visualized as volume profile. This same grouping reoccurring here would be totally normal, because price wants to move to areas where it used to accept that it has left a gap. So from a trading perspective, if you rewinded 3 or 4 days and we were trading up here, when you saw this high volume block pushing up and failing to go higher and dropping back into this area consolidation, you could look for shorts. On your lower time frame, you would start to look for short trades and you'd be targeting this area. I would be targeting this green box, but really you're looking for price to fill in anywhere within here. So what you're expecting to see in the next couple of days is for some of these, much like the days before. So we fill in some of the volume there. From there, it can either move back up, or if it begins to continue, or sorry, if it begins to head downwards, you start to look below for your other gaps. So we have another one here, because on this day it pushed up. And so this blue box, if it can't hold these previous levels, so using a horizontal line to visualize this, you have these previous levels of consolidation and then this one. If it can't hold, it's going to start to fill in more of this gap down to there. And that's when you start to see a deeper sell-off in the market as a whole. Okay? So, in summary, volume profile is very useful to visualize daily sessions on the charts. The daily sessions are shown in a vertically aligned bell curve, a normal distribution, showing, or a distribution chart, showing the volume from highest to lowest, and from the top to the bottom is the lowest wick of the day to the highest wick of the day, and around the point of control, which is the red solid line, that'll be in the middle of the body of your candle. Using that, you can begin to ascertain support and resistance, because where you have areas, when you've got areas of multiple days with volume buildup, you can see that as resistance when you're below it and support when you're above it. So even though we're above here, before that we had pretty high volume in this area, a decent grouping of volume in this area, and a couple of days more before we went up. So you wouldn't expect price to just go all the way through this, because the purpose of these volume clusters is that they're supposed to provide support and resistance. And so even just by having only the volume profile on, you could again draw one level and say, okay, this level is significant. I think you know by now why it's significant, because we had a bunch of volume clusters in that area. Well, can't you then say, there's my horizontal support resistance level? So, two things can happen. Price can come down, hold. If it comes down and holds, I'll go long. If price comes down and fails to hold and retests it, and it seems to be trading below it, well, then I go short. It's a very simple way to add confluence to your support and resistance levels as a price action trader. So looping back to the beginning, it really is straightforward. Do not overcomplicate it. Look for gaps, wait for them to form, and then look for signs that price is going to head back towards those levels because it wants to fill them in. Don't worry about why. Price just wants to be normally distributed. And so I know that volume profile can be overwhelming at times, as can the tape, which we're going to discuss in the final lesson of Module 4. But do not get lost in the details. You don't need to look at every number. You don't need to look at every candle. You don't need to look at every piece of the chart. What you do need to look at and what you need to focus on are anomalies. And anomalies are where the market strays from the normal distribution pattern. And in volume profile, it's best expressed through the gaps. So you can see those gaps by looking purely at the candles, if I turn them back on. If I overlay both briefly, you can see the gap here very clearly. This candlestick pushed all the way up, okay? And so if I remove that for a sec, gap. And then we do all our distribution, we do all of our distribution up here. Put it back on. There's the gap. So you can visualize the gap just with candles, or you can visualize it using the market, the volume profile, or smart traders will use both. You will start off with your candlestick charts. You will say, oh, price is pumped up to here. It's gapped up is a term that I use frequently. It's gapped up, or if it drops, it's gapped down. You do that and you say, okay, this is gapped up and we've consolidated for a couple of days. let me put on my session volume profile and take a look. So you put on your session volume profile and you take a look and you see, yes, in fact, there was a lot of bunching and consolidation here, really nice tight consolidation. That should be a pretty solid support level if we come back and test it, because it was a level that should have been resistance and it held initially, and then we broke through it. If you break through a pretty significant resistance like this with relative ease, you'd expect that we can hold it on a retest. You can say, okay, when price comes back down into this area, I would expect probably more likely than not that it holds and that we go higher. So that's how you can use the session volume profile. There's one more I'll touch on briefly, which is the visible range volume profile. So it's VRVP, again on TradingView, again free, or whatever you use your TradingView subscription. I'll go to a higher time frame one for this, go to an hourly chart, zoom out a little bit, and you can see it like this. So it comes up as a distribution on just the right hand side, and you'll notice that as I move, it moves because it's the visible range. Okay, so this one is useful for seeing a range that you want to look at. For example, the very, very bottom of this last move, which is 15.5, right up to the top that we put in a few days ago at 17.4. Okay, so if I put it like this and hold it and see, you can see most of the volume in this move has been distributed at the top. What are these levels? I'm sure your pattern recognition skills are improving to see what are these. These are gaps. What happens to gaps, especially in ranging markets like we are in as I record this in December 2022? We're in a bear market and we're in a broader, if I take away this, we're in a broader range, as you can see, because we are consolidating after a massive drop. So we're still in a ranging environment. And when we zoom back in and we look at bottom to top of this move, you can see my boxes which were there. Gaps. Gaps in the chart, and gaps tend to get filled. So we've put in a bunch of volume up here. Price is now below that. If it can't reclaim and push strongly up, it's going to come down and fill in some of this. Again, no reason or no need to speculate too much as to why. It just likes to do that. The price would like to come down and leave this distribution looking a lot more filled in. Yeah, so that it's got more even distribution of volume, which on the chart would just look something like this. Comes down, consolidates a bit, comes down, consolidates a bit, and then starts to go up again. And that's just how the markets like to move. All right? Doesn't happen every single time, but you're not here to be right every time. You're here to play the probabilities. And using volume profile is one of the best ways that you can discern real moves from inefficient moves that are likely to reverse and be able to take better trades based on that. So that is the end of Module 4, Lesson 5, all about volume analysis. And we're going to move on in the next module to the final one, which is about reading the tape.